when an audit firm has a failure of independence, it's not the audit practice, it's the firm that failed to be independent. Regardless of what your service lines are, a focus on professionalism, a focus on independence, and a focus on audit quality have to be core to what the firm is.
Welcome to CPA Australia's With Interest podcast. I'm Elinor Kasapidis, Chief of Policy, Standards and External Affairs here at CPA Australia. Today we're looking at how the profession can strengthen judgement in an environment where risks are evolving faster than ever. Over the last 25 years, markets have been shaken by failures that always look obvious in hindsight. Enron, WorldCom, the global financial crisis, FTX. What's less obvious is that in the years leading up to each of them, the numbers still made sense to the people producing them. Today's risks, private capital, crypto, AI, feel familiar for that exact reason. The challenge isn't spotting fraud after the fact, it's recognising when a reasonable sounding story is slowly drifting away from reality while you're still inside it. To help us explore this issue today is our Audit and Assurance lead, Tiffany Tan. Welcome.
Thanks, Elle.
And joining us today is a very special guest who has seen these moments from a position few ever do. Paul Munter spent more than 5 years at the heart of the US Securities and Exchange Commission and previously was a partner at KPMG in the Department of Audit Quality and Professional Practice, as well as the global IFRS reporting practice. He ultimately served as its chief accountant, advising on how market information holds together and where it starts to fail. Paul, welcome to With Interest.
Thanks, Elinor. Great to be with you.
Paul, you've had a rare longitudinal vantage point, watching US markets and the accounting profession up close across multiple cycles. Let's go back to the late 1990s, the early 2000s. Enron and WorldCom were in the news. What, in your view, were the first points where the reporting narrative started to drift from economic reality?
So if you go back to those days, you get several challenges that ultimately manifested themselves in disasters, to be honest with you. But there were, first of all, some weaknesses in the accounting standards that existed at that point in time. And in fact, kind of following up on that, the SEC did a study on what were the key drivers of off-balance sheet reporting to identify where were those weaknesses in the accounting standards. One was with use of special purpose entities. Another was with respect to lease arrangements. And a third was with respect to post-retirement benefits, all of which were reflected outside of the financial statements, subject to certain requirements. But then the other thing you had was poor application of standards. If you look at Enron, for example, which is kind of a poster child for use of special purpose entities, and you drill down, in a lot of cases, they weren't following the existing guidance. So while certainly there were shortcomings in the guidance itself, beyond that, then you've got a company that was misusing the guidance that did exist. And then that, of course, was further exacerbated by a lack of high-quality audits around the information. So you really had kind of a breakdown of all of the pillars that drive high-quality financial reporting, which is high-quality standards, high-quality application of the standards, and high-quality audits of the information, which were illustrated by the subsequent collapses. And I think to the point you said in the tee-up is, it's oftentimes easier to see this in the rearview mirror than it is when you're in the moment. But I think it's a reminder that for those that are charged with providing high-quality information to investors, you have to keep focused on that objective, which is what is it that's going to provide meaningful and useful information to investors as your guiding star. And I think in these and other cases, it's pretty easy to see in retrospect that both management and auditors lost sight of that guiding star.
That's great insight, Paul. I mean, when you talk about Enron and WorldCom, I was just a baby back then, like at the infants, not a baby. I was just starting out my career as a junior auditor, so fresh grads, very green, don't know what's going on. And what I recall at that time is with Arthur Andersen, then following them collapse, it's like, holy crap, Arthur Andersen, it's like one of the big five at that time. It's like aspire firm to be in for all the new grads, audit grads that wants to go in. I'm like, oh my God. And then the news break and how they're shredding and like not good example, but it was really interesting time time, and I think the profession learned a lot. But, one thing that happened in that time as well is because we talk about how Arthur Andersen didn't just lose one major client, that was a major client, but the firm itself collapsed because of the scandal, right? So one of the things that, from your point of view as a SEC at the time, or, when you are at KPMG, maybe, I can't recall where stage of career is, how did you see that unfold as a system event, and where did the breakdown become undeniable? Like, you can't dispute that is basically broken.
Yeah. So it really gets back to the audit firm being focused on its core responsibilities. And later, when I was actually at the SEC kind of at that point in time, and then I returned after I retired from KPMG and was back again. And when I was there the second time, spent a lot of time talking about audit firms having to be focused on audit quality and audit independence, regardless of what services they provide beyond the audit. And, if you look in retrospect at Andersen, and frankly, the other firm probably had some of these same issues, but without the catastrophic consequences, is you had a lot of situations where partners were being motivated through compensation and evaluation and the like by their selling of non-audit services to audit clients, for example. There was certainly a lack of oversight of the audit profession. We were back in a peer review structure back in those days, so there was a need for stronger oversight of the profession. There wasn't the same kind of focus on quality control or systems of quality control within the audit firm and kind of across the audit firm, not just its audit practice, but across the entire firm. And the growth strategies of the firms were looking at things beyond the audit practice. Now, and I've said this before, I don't have a personal view on whether a firm should be a multidisciplinary firm or not. That's up for the firm to figure out what its strategy is and the like. But if they are going to be an audit firm as at least one of those disciplines, then that has to be core to their culture, regardless of what service line you're talking about. When an audit firm has a failure of independence, it's not the audit practice that failed to be independent. It's the firm that failed to be independent. And we've seen circumstances where independence violations have arisen from other service lines within the audit firm. So I think one of the real lessons out of that, is that regardless of what your service lines are and what your growth plans are and the like, a focus on professionalism, a focus on independence, and a focus on audit quality have to be core to what the firm is.
Yeah, I think completely agree with you, Paul, because I think that's why we also have in recent years the ISQM 1 standard. That one is definitely to deal with the quality of the firm, audit division specifically, and talk about the tone from the top, the culture of the firm, the governance and whatnot, doing the right thing. So it's really important because at the end of the day, auditors is all about trust. So if we break that trust, it's really hard to gain back that trust. I might shift gear now. We talk about Enron, we talk about WorldCom, another crisis, so you saw that coming. So what about the global financial crisis where scrutinized mortgages took down Lehman Brothers and threatened the system? And we can see that is like a snowball effect. When Lehman Brothers gone down, it impacted the whole world, not just the US. So from that perspective, what was the SEC most focused on and what changed out of that episode?
So there were a couple of things coming out of that. I think one is Lehman Brothers had engaged in what's now come to be called window dressing transactions, where they would do repos right near the balance sheet date to prop up their liquidity position, which were then flipped shortly after the balance sheet date, so that their liquidity position at the balance sheet date itself wasn't really representative of their liquidity position kind of over an extended period of time. And going back to the earlier point, some of that was arguably a weakness in the standard, which in the U.S., the FASB amended the standards in response to that. Some of that arguably was a weakness in disclosure practices, because there are certainly ways that the disclosures could have been more transparent to indicate that the balance sheet position was a bit of a temporary anomaly that was taking place. And then there were also, it exposed some larger structural issues, which you're alluding to, Tiffany, where you have Lehman collapsing and that cascaded. And that gets to a question of, well, and this is a bit beyond accounting and financial reporting, but from a risk management perspective, do you understand fully counterparty risk? And can you see through the channel to really understand what kind of counterparty risk you have so that you can manage that counterparty risk? Now, that ultimately does get back to disclosure. Probably a lot of that is outside of the financial statements. That's perhaps management commentary or what we might call risk factors or the like. But it ultimately gets back to the risk management processes and the degree to which you understand when you enter into a transaction, what are the risks that you're actually taking on? Have you accounted for them properly, number one? And number two, have you explained those in a fashion that's transparent and understandable to investors?
Picking up on that, I could talk about the GFC all day, but the whole mortgage-backed securities, even securitization as a concept, was fairly new to many investors. And it took pension funds, Freddie Mae, Freddie Mac, quite by surprise when all of this started to collapse. And Lehman Brothers was the most obvious. But other banks, other lenders, other borrowers were also in a very tricky situation. And you talk about the ninja loans, no income, no job. How do you look at that as a regulator in the market and you sort of see this risk growing, or this market perhaps, before you even see the risk? What sort of deliberations are you undertaking as it's unfolding, or does it need a trigger event like the thing that just cascades through the system and you become a reactive regulator, I guess?
Yeah, and I think depends on what kind of regulator you're talking about. From a securities regulator perspective, there's a question as to whether those kinds of structures are within your remit, other than trying to make sure that there is sufficient transparency around that. Now, there is a financial stability aspect to securities regulation that is in play. Obviously, the strength of the regulatory tools that a securities regulator has are different from one jurisdiction to another. But a lot of that, I think, falls within the purview of prudential regulators who have not just a financial stability mandate, but a safety and soundness mandate. And your example about these mortgage-backed securities is a really good one, because you've got two things going on. One is you've got a trend where you've got mortgages being originated with lower and lower quality customers to the mortgage, but that seemingly not being adequately priced into the mortgage. And then you've got the repackaging, the securitization, so that now what you've done is you have amplified the risk when you securitize it. And then to take it a step further, of course, you've got the securitization of an MBS. So you're, securitization squared or cubed, depending upon how many iterations that you have. And so now the risk that was inherent in the original mortgage has been amplified through the various iterations of securitization. And I think what that says is, in a lot of places around the world, probably the U.S. as well, is it at the moment, it wasn't entirely clear as to who, if anybody, has the regulatory responsibility and authority over those subsequent iterations of these securitization pools, which is why, not surprisingly, in the U.S., we had a legislative response. Dodd-Frank came into play after that. And obviously in other countries, there were legislative responses. And I think it served to indicate that we have to be continually vigilant to make sure that our regulatory regime is fit for purpose in light of what's going on in the marketplace at a particular point in time.
And hearing you speak, for us policy people, Tiffany and I, it makes sense. We can understand how these different iterations, these different crises lead us to the structures, the recommendations, the regulatory frameworks we have today. Speaking of today, we've got Bitcoin entering the market in 2010, and crypto, it is still a thing. But when we looked at FTX building market cap, sponsoring things, and then it collapsed and billions vanished overnight. do you see this same pattern recurring of you've got this new thing happening, you've got this excitement? Maybe I feel sorry for the auditors as well because they're dealing with things that they've never necessarily, in essence, had to deal with. They've got the processes, the controls. Again, what do we do each time one of these things comes up?
It's a question of first figuring out what is within the regulatory remit. And when you take examples like that, the question becomes, first, are you really dealing with what amounts to an exchange, which in a lot of cases, some of these are exchanges. And in the U.S., exchanges have to register. So there's a registration requirement to bring them within the regulatory authority. In the example you're dealing with, they did not register. And so they were outside of the SEC's examination protocols, for example. They weren't being audited by a PCAOB registered audit firm, for example. They weren't subject to capital adequacy requirements that are imposed on exchanges. And then going beyond that, some of them run brokerages. And there are, again, requirements for brokers and dealers to register and to maintain capital adequacy and the like. So it's really challenging when you've got these, and you of course have to balance appropriate regulation and not stifle innovation. There's obviously part of the trick to it, but it's difficult to have sufficient regulation when you don't have sufficient visibility into what's going on, which is why there are registration requirements in the first place. But if you don't have compliance with the initial registration requirements, how exactly do you get at that? How do you identify the risks and put preventive measures into place is the regulatory challenge.
And Tiff, from an auditor's perspective, so regardless of whether they're in the system or not, let's just say at the very least they had auditors, and yes, their accounts were on an Excel spreadsheet, and yes, they had related party transactions. Given your experience in audit, what do you think is an approach that the profession can take in exploring these new risks and these new businesses?
It's so hard. Every day, you come up with a new risk. And this particular example, FTX, right, is a good example because obviously it's fraud involved, right? So it's not like a basic, error in accounting or whatever. It's deliberate shifting money from US to offshore. All the money bypass US, just go offshore, right? So like Paul was talking about, it even bypassed the regulatory. It's not part of the regulated system. So in that context, and even if it's audited, but if they haven't got any requirement for the auditors to report or anything, like it's not part of the system, where does the report goes to? I don't know, no idea how to deal with this. Paul, you might be more experienced in dealing with this as an auditor.
Well, it goes back to a core tenet of audit, which is we're required to have appropriate technical competence for an engagement. And so, the auditor should be asking, do I have the technical competence here? One of the things would be to ask yourself not only about the technicalities of the digital assets and the like and how you go about auditing that, but asking, well, what should be the registration requirements for this company, if any? And do you have the appropriate knowledge, competence, et cetera, before you accept the engagement? So I think that's the breakdown from the audit side is the firm itself, it would appear, now I don't have inside knowledge on that, but it would seem as though the firm itself didn't stop and ask itself, do I have the appropriate competence to engage in this? Interestingly enough, if you look at the auditor of Madoff's structure, you see a similar kind of thing. You see a little tiny audit firm that is not auditing any other funds. Do you have the appropriate competence and technical knowledge to be accepting that engagement in the first place?
We can talk about this all day because I did hear rumor about how none of the big four, none of the reputable firm will want to touch this kind of entity, not because of anything else, but more because they don't understand well enough. That's the first thing, the competence, because obviously the auditing standard is comprehensive. We have ISO 210 about the acceptance and continuation of the engagement. So most auditors, if they're doing the right thing, they would have this is too hard. I know in my audit days, I'm from a mid-tier firm perspective. we stay clear from the banking industry. So we say, no, we're not doing banking. We will not do mining as well. So we will do the normal manufacturing and retail and whatnot, but we know where our expertise lies and we don't go there. Yeah, that's the point. Yeah.
Which then goes into the private markets where, depending on where you sit, there may or may not be a statutory requirement to have audit. But in Australia, and I think it's the same in the US, we're doing a lot of thinking around private capital and private equity. We've got trillions now, and it started small, but there are, I guess, lower barriers to investment in the private market. The investors are considered to be more sophisticated and more knowledgeable, which, given some of the thresholds, we do question. So from a market integrity standpoint, you were talking about what is the regulatory sphere for a regulator. From the US perspective, I think there's been a bit in the private equity markets and private issuances. How do you go from this, if you're just a listed public, to a range of different instruments and different types of entities? How do you see that evolving over time?
Yeah, so that's something we've certainly had a lot of debate on in the U.S. in the last few years, and there's kind of a couple of aspects to it. One is, which you're touching on, Elinor, is who should be allowed to invest in private equity, or if we go beyond that, private credit as a specialized form of private equity. And, we have rules on that, and there are questions about whether the rules are fit for purpose or need to be revised or what have you, and that conversation is ongoing. But that's question number one, is who should be allowed to invest in them in the first place. And then the second is, from a systemic perspective, which gets back to financial stability, is, well, how much information should they be required to report to public authorities, even though they aren't necessarily subject to their regulatory oversight, but just from standpoint of having information and understanding what systemic risks there are, how much information should be reported? And that's also a subject of debate in the U.S. So you've got both those things going on, and there's, of course, tension, right? That you've got some are in favor of a stronger regulatory regime and more reporting of information. Others have a perspective of, well, we ought to let the markets function more in a free market circumstance. And in most cases, the answer lies somewhere in between the two. That I think we've got a long enough history to say that markets operating completely unregulated is not a good formula from an investment perspective. You have to have some kind of regulatory oversight of it. And I think that's the same kind of debate we're having in the U.S., I suspect elsewhere, is to how much visibility do we need to understand what the risks are that are inherent in these structures, and who is it that should be allowed to invest in those kind of structures?
And I'm going to go a little left here. We talked right from the beginning about you need these pillars: standards, the application of the standards, and the audit. And we've touched on the regulatory space. In the profession, we are concerned about the lack of the pipeline of auditors. And I think the conversation today has really highlighted where you need independence, you need to have scrutiny, you need to protect the markets, investors, and just the broader economy from different kinds of changes. So, Tiffany, how do you see the role of audit, and why do you think it is this real challenge to get people to recognise the importance and be invested and see it as a career?
I want to say it's obviously a critical role. It's the trust in the system. You can have financial reporting, but if you haven't got the audit lens over it, it means nothing for most, because you're relying on an independent audit to be conducted to make sure that the numbers stack up. But I think one of the challenges is continued challenge. I'm not sure about in the US. I know I worked in Asia a little bit in my early days. That was horrendous. 6.5 days work. And I think the work-life balance is always a challenge. I know that in Australia, at least, it's getting better. With COVID, it shifted a fair bit of how we worked. A lot of working from home happening. And I think the important thing is really, some of the time, as an auditor at the initial stage in the early days, you're just almost like going through the process. This is my experience, may not be everyone's experience, but only until you observe in action. So I was in meetings and stuff like that with some senior partners, and when you see those audit debate happen in action and how it impacts the outcome of the financial report, and that's when you realize how important your role is, even though at that time I was just doing ticking and bashing. So the opportunity to actually observe positive those trust and integrity of audit brings into the set of financial statements in action, brings it home and say, my role is important. I'm here to find the truth. I have critical, I need to apply critical mindset and professional judgment. I need to escalate if I find issue and, be brave, ask the challenging question. I mean, I'm green, but, at that time, so I did experience that one of the CFOs say, where did you find this girl? She's so green, but she's absorbing it like sponge. She keep asking questions, too much question from her.
I love that, though. It's about the curiosity.
No, I think that's a great point, Tiffany. I think one of the lessons that I've tried to instill in people that I've worked with or who've worked for me is ask questions. And if the answer doesn't make sense, keep asking questions until you get an answer that does make sense. Because oftentimes, if you look back in retrospect at some of the failures, it's you either didn't ask the question, because in a lot of these red flags were there that weren't pursued, or you asked a question, got an answer, and drove on, even though you didn't necessarily fully understand it. So I think that's a really good point. I think the other thing, in terms of the pipeline part of the question, is as a profession, we have not done a very good job of explaining the value proposition to people, and particularly those who are thinking about coming into the profession. That the audit profession is instrumental to capital formation. It's instrumental to being able to raise capital, regardless of whether you're talking about through equities, through borrowings, through other financing vehicles, but do so at a reasonable cost of capital so that you can invest that as a business and generate a return on that. And so we haven't explained that, and that's what you were touching on a moment ago, Tiffany. We haven't explained that to people very well. The other thing we haven't done a very good job of explaining is what are the career paths that are available. And I kind of look back on my career, and you touched on a couple of the things I've done, but I've been very fortunate to be able to do a lot of different things. And if somebody had told the 20-year-old Paul, here are the things you're going to have the opportunity to do, and here are the people you're going to be able to engage with and the like, I'm not quite sure how I would have reacted, but it would have been very interesting information. And we don't do a very good job as a profession of explaining either of those things to younger people that I think would help them understand why it's useful to go into the career and what kinds of opportunities and career paths and satisfying progressions they can engage in. And I think we would serve ourselves well if we did a better job on both of those fronts.
I'll add to what Paul said, though. It just reminded me. I did say that it's a hardworking role, being a junior auditor, right? But one of the things that keep me going is the promise of travel.
Careers, destinations.
Travel. So I have secondment in UK, and I'm going to Manchester, Birmingham. It's snow when I have to have an audit clients at Birmingham. We end up with the chocolate factory, Cadbury. So it's not an endorsement, but you know what I mean? I think those are the things that young people back then, my time, I really look forward to the travel. Oh, next week I'm in here. Next month I'm there. And the other thing that I stick with audit for a while, obviously, and hence I'm here today. I don't think I will last maybe a year in the corporate environment because I'll be doing balance sheet and P&L and whatnot every day or journal entries every day. But in the audit role, you go from a client in the fashion industry to a abattoir, a slaughterhouse, right?
Yeah.
It's quite a different perspective, and the people that you meet. Like I always say to the junior staff that that I take them on audit, I say your 3 years spent in the audit firm is the best time. It should be hard work, but we play hard as well. But it is the fastest time you can get your experience because you see across all sector as well, different people. And I love the people factor. And I did feel that once I did get into technical stuff, and once I'm in technical, my people facing time decreased significantly. I'm like, oh, that's not what I want to do. But you know what I mean? Like depending on the personality as well, I think as an auditor, there's a lot of prospect. It's a very interesting job. From my perspective, I might be biased. Yeah, but it's that getting through that discipline, the hard work, and learn, be inquisitive, keep asking questions.
So we started with corporate collapses and we've finished off with audit careers. Thank you so much. I think really what this has highlighted is the critical nature of the profession, the depth and variety of what opportunities professional accountants can have across the various spheres of regulation, of business, management and audit. And Paul, thank you so much for taking the time to sit with us today and share your experiences.
My pleasure. I've really enjoyed the conversation.
Thanks, Paul. Thanks, Elle, for hosting.
And thank you for listening to With Interest. We have a range of audit tools and resources on our website, including guidance on systems of quality management and career pathways. Please hit subscribe. Until next time, thanks for listening.